We are going to start. Haley, can you talk? Can you?
Yes, I can.
Okay, I'm sorry. I had my computer on mute. Okay. Okay, sorry about that. I have an obnoxious clock that goes off. So I just muted all my computers. And can everyone hear me fine?
Yes, I can.
Okay, Haley can, great. So, why don't we start by, Brian, do you want to start the recording? Haley, I'm going to switch over so we can see your stuff. So we're going to start in about 30 seconds here.
Sounds good.
Okay, Haley, can you see this?
Yes, I can.
Okay, so I'm going to start and then I'm going to hand it over to you in just a minute. So we're going to get started. Just so you know, Haley and Brian, I have no way when I'm application sharing to see the chat room, okay? And I have no way, so I'm kind of doing this blind. So you're going to have to hop in audio-wise if you need me. So everyone else in the room, I can't see the chat room at all. I can only see this review sheet that's in front of us. So I'm going forward. Haley and Brian, I'm going to rely on you to jump in if there's something I need. Okay?
Okay.
All right. That sounds good. I'll monitor the chat room.
Okay.
Wow.
Okay, thank you. Okay. So, Brian, you're going to start record?
I already did like a minute ago. Sorry. I did it at 10.
Oh, that's good. Good. Okay. So we are getting started. The Exam 2 review session is starting, and the URL is on the screen where you would find the review sheet that contains just about everything that we've got today. We have an agenda. We're going to go over exam information. Some basic exam information, which is me, and then Haley has been tutoring for the last few weeks, and she's going to share some observations she's seen about common misunderstandings of things, and then I'm going to talk about this overview of chapters 5, 6, and 7, and then Brian's going to talk about what he saw when he was going over exams with students, what he saw that was a common missteps that people would make, and then we'll take questions. So with that, I'm going to start with the exam information, just the basic review. Exam 2 is Monday through Wednesday next week. It automatically submits at 9 p.m. on Wednesday. If you're in section 7 or 8, make sure you schedule with ProctorU at least 72 hours in advance. This information I'm giving you now is not on the exam review sheet. It is on Blackboard under exam info. Okay, if you're in sections 1 or 2, proctor hours, same as last exam. Beware of lines. There could be lines. There's lots of exams going on this coming week, this next week, where we have ours because the drop date is Sunday, so I think there's a lot of people having exams. This exam covers chapters 5, 6, and 7. You do get to use a review sheet just like before. You need to have a photo ID and see official exam information on Blackboard. Okay, so with that, I think I'm going to give this over to Haley to talk for a while. So this is you, Haley.
Thank you. Hi, everybody. Okay, so some of the problems that I noticed that people were coming across in tutoring are some of these points below. The first one that I noted is for the units of production method for depreciation. It is the only method that uses some type of units instead of the useful life as years. The second problem that I noticed people we're having was understanding that when you're capitalizing an expenditure, you're going to be debiting an asset. The third problem that I noticed people were having were, well, the third and fourth were with FIFO and LIFO. The first one, the FIFO method, that means first in, first out. So what this means is that the oldest items in your inventory are sold first, and as a result, the items in your ending inventory are from your most recent purchases. And then for the LIFO method, this means last in, first out, which means that the newest items in your inventory are sold first, and as a result, the items in your ending inventory are from your oldest purchases. Okay, and that's about all I have for those tips.
Okay, so was tutoring busy this week?
I'm sorry, what did you say?
Was tutoring busy this week?
Yes, tutoring was very busy this week. Almost every session that I had was full.
Okay, and we're not going to have tutoring next week because of the exam, but we're going to have it the following week.
Mm-hmm.
Okay, and then Haley, I'm getting emails from people who want to know where to attend this session, and I can't answer emails and talk at the same time. So perhaps you could go into Blackboard Announce. You don't need to leave this session, but you can go into Blackboard Announce and put up an announcement with the URL to this session. Okay. And email it out. Go into our class, hit Announce, and make sure at the bottom that you click Send to everyone. So we're just going to generate a blanket email because I can't be answering emails during this. Okay? So thank you. And I did get this up on my screen so I can kind of see the chat window. So I have a second computer with it on. So, okay, with that, I'm going to start, and then we're going to circle back to Brian when I'm done. So we are on the exam review sheet now. And the first thing I do want to emphasize is to use study plan to practice the exercises. This exam, about 25% of the exam is exercises, and those exercises come from study plan specifically. Same exercises, different numbers. And then also, I have put multiple choice in study plan. This multiple choice are great for practicing, and you may find a few of those multiple choice on the exam also. So don't overlook those multiple choice. Do the exercises. Study plan is one of the best tools. It's not the only tool you should use, but it is a very good tool. Okay, so next we have, so we're going to starting at Chapter 5, Investments and Receivables. When we talked about this chapter, we said there were 3 categories of trading securities. And I am now on the review sheet. It's just going to be broken up, but it's in the same order now. And I've tried to put in red the notes that I've added this morning. So we have 3 categories of short-term investments. The one that we talked about in this chapter was trading securities, and these are ones that we buy with the intention to sell them quickly. So we also have available for sale securities, held to maturity securities. Those can either, the available for sale can either be current or long-term, but the major emphasis in this chapter was trading securities. So that's the one to be really familiar with, and these are ones we intend to sell quickly. Okay, so that's the intent, and because we intend to sell them quickly, they are classified as current assets. They're up down below cash on the balance sheet, so they're very, very high on the balance sheet, very close to the top of the balance sheet. Okay, let's see. Okay, next, trading securities and related journal entries. I did add a lot to this one. We have purchase. When we purchase a trading security, the journal entries for that is we would debit some kind of investment account, credit cash. When we receive dividends, we would debit cash, credit dividend revenue. So those are the 2 big journal entries having to do with trading securities. And then unrealized gains and losses. You need to know that unrealized means we have not sold this security yet. we still own it. This is an adjustment to its market value or fair value. So whenever you see the word unrealized, that means we still own it. Okay, I'm going to pause for a minute because I can't see anyone writing, but I'm assuming people are still writing. Okay, so I'm going to go forward, but again, the emphasis there, unrealized means we have not sold it yet. We still own it. Okay, next, moving down, reporting on the balance sheet and income statement. Trading securities are at market value on the balance sheet, and they're on the balance sheet as current assets. Because we have this intention to sell them rapidly, they are current assets, meaning that they're going to be converted to cash in less than a year. We have accounts having to do with trading securities, dividend revenue, sometimes we have some interest revenue, unrealized gains and losses. Those are all income statement accounts. Okay, so we have trading securities on the balance sheet at market value as current assets, and then we have dividend revenue and unrealized gains and on the income statement. So I'll pause for a minute. Okay, so next, applying generally accepted accounting principles for proper revenue recognition, including journal entries. So we'll kind of hit on those too. First of all, know the shipping terms. When we talk FOB shipping point, that means the title transfers at the shipper's place and sale is recognized when it leaves the shipper's place. So shipping point means everything's happening at the point it's being shipped. And that means where it's departing from. And FOB destination means that the title transfers at the buyer's place and the sale is recognized when the buyer receives it. So those are two very key terms about who owns it when. So know FOB shipping point and FOB destination. And again, I'll pause for a minute, let you write that down. Haley, if you have your mic on, can you turn it off? Turn your talk button off? Or Brian, one of you does?
Mine is already off.
Of course. Okay. So then we have sales discounts. Sales discounts, know that sales discounts result from early payment. Okay, sales discounts, and that's key. So sales discount isn't because you're getting it on sale, it's because you paid early. Those credit terms like 210 net 30, 2 means you're getting a 2% discount if you pay within 10 days. Remember that the day of the sale does not count as one of those 10 days. And if you don't pay within the 10 days, you pay the full invoice within 30 days. That's how you interpret 210 net 30. So sales discount, that's a very specific account. It relates specifically to paying within that early payment period. Okay, and then we have sales returns and allowances. Sales returns and allowances are when we have something returned to us because the customer doesn't want it anymore or there's something wrong with it. Sales allowances, we give the customer some amount off because there's something wrong with it. So those are sales returns and allowances. Sales discounts have to do with the payment. Sales discounts and sales returns and allowances are both contra revenue accounts. I don't have that written down here. Let me see if I can write that down here. Okay, those are both contra revenue accounts. Okay, so contra revenue accounts. So those are good to Here we go. Okay, so the good to know that sales discounts and sales returns are both contra revenue accounts. Okay, I think we're done. This is really weird not being able to see how far people are with writing. Just guessing here. Okay, so next on, moving down for accounting for accounts receivable. So receivables are also in Chapter 5, and there's two kinds of receivables that we talked about. That would be accounts receivable and notes receivables. So internal controls over cash collections, you don't want the same person collecting cash, so having the cash and making the journal entries, because then you can make whatever adjustments you want. So that would be a way to easily steal money. So internal control, we talk about separating cash from the accounting for the receivables. Managing the risk of not collecting, we have to make sure that we're very proactive with collecting accounts because we want to collect our money. Okay, and then subsidiary ledgers or subsidiary accounts. This is where we maintain an account for each customer, and if we add all those subsidiary accounts up, they total the total of accounts receivable. It's just a way to keep track of what our customers owe us. And then net realizable value. Net realizable value is accounts receivable less the allowance for uncollectible accounts. So that's the formula. You're taking your accounts receivable, subtracting your allowance for uncollectible accounts. Allowance for uncollectible accounts, I guess we should write that. That allowance account there, that is known as a contra asset. Okay? So that's a contra asset, so the contra asset in this case is the allowance account. Okay? So the contra asset is the allowance account. Okay, that is a contra asset, and that gets subtracted from accounts receivable to get our net accounts receivable. Okay, let me go on. Okay, next, allowance for uncollectible accounts. We have two ways to maintain this allowance for uncollectible accounts, two ways to estimate our bad debts. And I guess that's another important thing here. Two ways to estimate bad debts. Okay, so when we're talking about the allowance method and the percentage of sales method, those are both ways to estimate bad debts. Okay, so percent of sales method is one of those methods. Okay, so we have the percent of sales method, and we have the aging of receivables method. So both of those are allowance methods. They're ways we have to estimate how much our bad debts are. Okay, percentage of sales method is called the income statement method because basically what we do is we take our sales and multiply by some percentage, and we say that's how much expense we have, bad debts. That's how much we're not going to be able to collect from this period's sales, and then we're going to add it into the allowance. Okay, and then we have the aging of receivables method, which is known as the balance sheet method, and this one's a little more involved. With this one, what we do is we say, we're going to do this aging schedule, and we're going to kind of estimate based on how old our accounts are what's going to be bad. So we're going to come up with this estimate of how much total bad debt we have, and then we're going to adjust the balance of the allowance account to be that number. And this is known as the balance sheet method because we're focusing on the balance sheet balance of the allowance account. The percentage of sales method, skipping back to the first one, is based on our income statement because we're looking at this period's sales and we're asking the question, what percentage of this period's sales are not going to be collected? Whereas with the aging method, we're saying, let's look at the total balance of our receivables and what part of that is not collectible. So we have one emphasizing the income statement, one emphasizing the balance sheet. Companies pick one or the other and they go with it and they're consistent. And again, down at the bottom, what type of account is allowance for uncollectible accounts? That is a contra asset. Okay? Okay, so I'm going to go on now. Now, the journal entries for establishing the allowance under the allowance method, whichever way we do it, whichever method we use, we are going to have the entry to establish the allowance is going to be to debit uncollectible account expense and credit allowance for uncollectible accounts. Expenses have a normal debit balance, so we're increasing expense there, and we're crediting allowance for uncollectible accounts. It's a contra asset, so it has a normal credit balance. Now, the entry to write off an account under the allowance method is we would debit uncollectible accounts and debit allowance for uncollectible accounts and credit accounts receivable. What we're trying to do here is we're trying to pull it out of our books completely. So this is a very specific term. I do want to point out here we're talking about writing off an account. So this is a specific account that we want to write off. So when they say, we've determined that Michael Smith Builders is not going to pay us, that's writing off a specific account. There is no income statement impact of that action. We're going to debit the allowance for uncollectible accounts, credit accounts receivable. We're pulling them both out of that account. Allowance normally has a credit balance, so by debiting it, we're reducing it. Accounts receivable has a normal debit balance, so by crediting, we're reducing it. So we are just simply pulling that account out of there because it's in both already. Okay, and then moving down to the bottom here, what I've got on the bottom, the direct write-off method. This is not GAAP. The direct write-off method says, we're not going to do any of this allowance stuff. We're not going to have an allowance count at all, and we're just going to record an uncollectible account when we find it goes bad, when we decide they're not going to pay us. So we're not going to estimate collectibles at all. We're just going to say, oh, this account's bad. Let's do debit uncollectible accounts expense and credit accounts receivable. This is known as the direct write-off method. This is in exact opposition to the allowance method. Okay, this is not writing off an account under the allowance method. Writing off an account under the allowance method, we're just backing it out. Here we're saying we don't have any bad debt allowance at all. We don't set up an allowance. We don't do any estimating. We wait until something goes bad. The problem with the second method that's not GAAP is that we're not matching the expense of bad debt to the period in which we made the sale. And remember, we don't know which accounts are bad because that are going to go bad when we make the sale, because if we did, we wouldn't sell to those people. So direct write-off method, if you see direct write-off method, this is what it's looking for. We're writing it off with having no allowance. Okay, so then let's move on here. Okay, notes receivables, some key terms. We talk about the creditor. The creditor is the one making the loan, making the note. The debtor is the one signing and getting the money, borrowing the money. Interest, how to calculate. You take your principal times your rate. Your rate is quoted on a 12-month basis, and then we adjust for the number of months. So we're going to take the number of months divided by 12, because a lot of times these notes are on a monthly basis. We can also have a daily basis note, so we would take the number of days divided by 360 or 365, however they're doing it. So principal times the rate, and then we have to multiply by the portion of the year that this is for. We have a maturity date. We have a maturity value. Maturity value is going to be the principal of the note plus the interest on the note. And then we have principal, which is the amount borrowed, and then the term is 2 months or 3 months or whatever this note is, that's the term. Okay. Now we're moving on here. Okay, we've got some journal entries for the I just put some review journal entries on here because I think they're useful. Journal entry for establishment of notes receivable. So when we originally make the note receivable, remember we are doing this from the standpoint of the company that's loaning the money. So we're going to be debiting a note receivable, which is an asset, and we're going to credit cash or sales revenue or accounts receivable, some credit. Typically we have seen, if I were picking which one of those was most common, I would be picking sales revenue there. Okay, so pick sales revenue, not sales revenue, I'm sorry, cash. That's the most common one that we did in class. So let's see, so you would typically expect to see cash in the journal entries that we see. So we'll debit notes receivable, credit cash. Another entry we have under the for receivables is to accrue interest. If we have this note at the end of the year and it's not matured yet, we need to recognize that we have notes receivable revenue, interest revenue. So we would debit interest receivable, credit interest revenue. Okay, these journal entries, the reason I put them on here is because they are standard and because we might see them. They are so standard. Every time you see them, they'll look like this. So this is something good, I think, to put in the margin. Okay, and then the last journal entry here is for when we collect the note. So the note, they pay back the note. So we're going to collect cash for the principal plus the interest. So we're collecting cash actually for the maturity value. So the cash, we have maturity value. Okay, so that is going to be the cash is going to be maturity value, which is principal plus interest, okay? And then the credit will be notes receivable. The credit to notes receivable, maybe I'll put this one over here too. The credit to notes receivable is going to be for the principal amount. Okay, and then the credit to interest receivable would be for any interest accrual we had at year end, and then the credit for interest revenue is the interest revenue to date. So interest receivable and interest revenue, you have the portion that you earned last year, and then you have the portion you earned this year, and that's how you do that. So you have one debit for cash for the maturity value, and then you have 3 potential credits here. Okay, I am going to move on now to a new chapter. Okay, so the next chapter we see here is inventory and cost of goods sold. Now, inventory and cost of goods sold, first of all, the difference between a service entity and a merchandising entity is a service entity has no inventory. Okay, a merchandising entity has inventory. Okay, so when we see this, the merchandiser has inventory, but a service entity does not. In reality, by the way, we do have companies that have a little bit of both. You could be a lawn care company and stock grass seed for sale to customers, so you have some inventory there. But we just treat it as though you're either service or merchandising to keep it simple. Okay, so now we have the sales price versus the cost of inventory. When we talk about sales revenue, we are referring to, maybe these are good ones to write too. This will be the selling price, based on the selling price. Okay, cost of goods sold will be based on the cost. Okay, inventory, the value of our ending inventory is based on cost. Gross profit is going to be based on both, okay, because gross profit, you're going to have the selling price minus the cost, so both things are in there. And then number of units in ending inventory, we calculated that in class. We put down a formula for calculating how many units are in ending inventory. The number of units in ending inventory is going to be is going to be the beginning inventory plus your purchase minus your sold. That's how you calculate the number of units in ending inventory. And then the cost per unit of inventory, that's where we're going to answer. We're going to use average cost, we're going to use FIFO, we're going to use LIFO. So we'll be talking more about that. Okay, so I'm going to move on now. Okay, accounting for inventory in a perpetual system, the difference between a periodic system and a perpetual system. A periodic system updated at the end of the period. A perpetual system is updated continuously, okay? And we kind of blend these two in class, so I wouldn't get too worried about the difference in entries between the two, but periodic means we update at the end of the period, perpetual means we update continuously. Okay, to get net purchases calculation, we're going to take, let's do purchases, okay, and so here's what we're doing. We're going to get our net purchases, we're going to take our purchases and add in, we would add freight in, so maybe we should do this. We would add freight into our purchases. We would also add taxes we pay and insurance as well. Okay. We are actually going to subtract purchase returns because that reduces what we bought. We're going to subtract purchase allowances from purchases, and we're going to subtract purchase discounts. Let's talk quickly about what these items are. Okay, freight in is what we pay to get our purchases to us, and we might pay tax on our purchases. We might pay insurance, so we add all that to our purchases. Then from that figure, we subtract purchase returns, which are purchases we return because we didn't want them. Purchases allowances, which are reductions in the purchase price we get because something's wrong with it. Maybe it's the wrong color, maybe there's a dent in it, but for whatever reason, they subtract that from purchases. And purchase discounts are those reductions in purchase price we earn because we paid early. So we're going back here to those terms, 210 net 30. If we pay early, if on a purchase we make and we get the 2% discount, that's a purchase discount. So again, purchase discount is not referring to some discount we get off the sales price. It's only referring to the reduction we get because we paid early. Okay, so let me go forward here. Okay, inventory methods. We have several methods. We have 4 that we talked about. So these inventory methods, when we talk about these inventory methods, there are 4 methods to determine, cost of inventory. Okay, so there are 4 methods. And the first method is specific unit method. And what we've got with there, the specific unit method, this, or specific unit cost, is we actually identify the unit. And we can use this with expensive inventory. We can use this with inventory that has serial numbers. It's very unique situations that we can use specific unit. Most of the time it would be too costly to do that. We can also use average cost, which is what we do when we take all our costs, divide by the number of units. And sometimes companies do that. Remember, companies pick a method and stick with it. So they choose the method and then they go with it. Okay. So first in, first out is another method. And first in, first out, the first units purchased are considered to be the first unit sold. So ending units ending inventory is made up the most recently purchased items. And this was one of the things that Haley talked about, is knowing, writing down what FIFO means, because it's really confusing to read it. You won't know it immediately. Okay, or at least I don't. I still write it down. I still reason out which units I have in ending inventory, which units I have in cost of goods sold. And then LIFO, last in, first out. Okay, those our last ones we bought are the first ones we sold, so our ending inventory is the oldest items. And then we went over a chart in class or in the videos about which LIFO or FIFO will be the highest cost of goods sold, the gross profit, and ending inventory. In class, I don't have it replicated here, but on October 14th and 16th, I had some basic charts, and especially on October 16th, where I had how to calculate cost of goods sold and then how to calculate gross profit. And there were charts, and we could trace the impact of various errors in inventory if we overstated or understated. Those are good to know. Those are good to write down. Okay, and then next is GAAP for inventory. Just going to hit this briefly. We have accounting principles, consistency, making sure we use the same method over time. Disclosure, the company discloses in its financial statements which method it's using. Then we have the lower of cost or market rule. We report inventory at its historical cost or its market value, fair replacement value. Remember, so that's another word. Maybe that's a good one to write here. Replacement cost. Okay, so that's another one where we can say replacement cost, market value means the same thing. Okay, whichever is lower. So whether it's historical cost or its replacement cost is lower. So those are that's a lower cost or market rule. Okay, then moving on, we have inventory and detailed income statement. On the inventory on the income statement, what is impacted on the income statement, and what about inventories on the balance sheet? Okay, inventory is a current asset on the balance sheet. Okay, cost of goods sold is the second item on an income statement. Okay, your income statement is sales revenue less cost of goods sold. I'm pausing here for a minute because I know there's a lot of red on those on here, and red is what I added to the review sheet. Okay, so inventory is a current asset on the balance sheet. Cost of goods sold is the second item on the income statement. And actually on the income statement, first item on the income statement is sales revenue. The second item is cost of goods sold, which cost of goods sold is calculated by using inventory. So sales revenue less cost of goods sold, that gives us gross profit or gross margin. Okay, and then the last section, inventory errors. This is know the impact. And again, those class recordings where we talked about if we understate this or overstate that. So we have those recordings from October 14th and 16th. Those are good to review. Those, and knowing those charts and being able to trace your way through and recognize the impact of doing something, of making an error. Okay. Okay, and now I think we're moving on to Chapter 7. Okay, Chapter 7. We just did this week. So types of long-lived assets. So these are plant assets and intangibles. We have plant assets, which are going to be things like land and equipment and buildings and land improvements. We have natural resources like timber and oil. And then we have intangible assets. And intangible assets are things like copyrights and patents. So that's what this chapter is about. These are assets that are very long-term, so they're under long-term assets on the balance sheet. The types of plant assets, we have land. Land does not depreciate. It's considered to be an infinite resource, an infinite asset. Then we have buildings, machinery, equipment. The names of these can vary slightly, but they will remain similar. Then we have land improvements and leasehold improvements. Those are things like putting in a parking lot, putting in a sprinkler system, putting in lighting outside. I want to call your attention to being able to do a lump sum purchase of assets. I know we did one in class, a question in class. You got a homework problem on it. That's where you buy three things. You buy a building, you buy the equipment in the building and the land for $500,000. Here's the market values of each of them, and they add up to be more than the purchase price. And how do you allocate to that, to each of those? So that I just wanted to point out there. I'm not going to go through an example right now of that. Okay, next, looking at distinguishing a capital expenditure from an immediate expense. What happens if a company improperly capitalizes an amount that should have been expensed? So this is saying, what happens if the company did some routine maintenance and it should have been put in expense, but instead they made it an asset? And then vice versa, what happens if they expensed it, but it should have been an asset? So know those. We went over a couple questions to do with that yesterday, October 23rd in class. You might want to see that review that recording. Okay, measure and record depreciation on plant assets. First of all, know what book value is. We talked about it several times yesterday. It is cost less accumulated depreciation. Okay, so no book value. Okay, accumulated depreciation is that running total of depreciation from the beginning. Okay, so no depreciation. Look up the definition for depreciation. It's allocating the cost of an asset over its life. Measuring depreciation, you have the cost. You need the estimated useful life. You have an estimated residual value, which is also known as scrap value or salvage value. They mean the same thing. And then know what type of assets are depreciated. It's going to be your building, your equipment. It's not land. Okay? Natural resources are not depreciated. They are depleted. Patents are not depreciated. Patents are amortized. So know that terminology. Know what it applies to. Okay, and then we get into the depreciation methods. Okay, depreciation methods. Okay, first of all, straight line method. This is just a basic review. You take your cost less your residual value, divide that by the useful life in years. That'll be your depreciation for a full year. Remember, you have to get a portion of that if it's for a partial year, but straight line otherwise is the same every year. Units of production, you're going to take that depreciable value, the cost minus the residual value, divide by the useful life in units. So this is when we're talking about miles or number of copies, something like that, times the units produced. So this is, in class we had an example where we were flying an airplane for so many miles. Okay, so then double declining balance method. This is the one that's a little more challenging. Okay, for this one, this is a roundabout way. In class, what we did for steps 1 and 2, we combined steps 1 and 2, and we would have steps 1 and 2 would be combined to be 2 divided by the life of the asset. Okay, that's the factor. This is a shortcut way to get to step 2. So we can go straight from step 2 down to, we can do 2 divided by the life of the asset. That gets us the double declining balance rate. To get our depreciation each year, we take the book value times that rate. Okay, so doubling back to step 1, what we're doing there, a straight line rate is 1 divided by the useful life in years. That's actually a straight line factor if we were going to do that, and we multiply that by 2 to get the double declining balance rate. Or we can just take 2 divided by the life of the asset. So that's just a little background on where that comes from. We never depreciate an asset below its residual value. Okay, Notice the double declining balance method, it's the only one that we don't use residual value in the initial calculations. We do use it later if we were going to be depreciating this. If we were calculating depreciation for later years, we check each year to make sure we're not depreciating below the residual value. Once we reach the residual value, we don't depreciate it anymore. Okay. Now, comparing depreciation methods, we did a little bit of that in class. Double declining balance method, the high point is it's the accelerated method. It's going to produce more depreciation than straight line in the early years. Other issues in accounting for plan assets, that's going to deal with the depreciation for tax purposes. So I guess that's kind of a subset of that. Depreciation for tax purposes means that we can use a different rate, a different method for tax than we do for books. That's totally legal, legitimate, and required in many cases because the tax code dictates how we depreciate for taxes, but yet we have generally accepted accounting principles that dictate how we do it for financial statements, and those two are different. And then knowing to depreciate for partial years, you need to adjust. You don't ever need to adjust the units of production though because it's already adjusted. It tells you how many miles they used that year or whatever. Okay, next page then, or my next page, we're just continuing. Okay, effects of a plant asset disposal. Okay, if you get rid of something that's fully depreciated for no proceeds, you need to remove it from your books. If you sell a plant asset, you also need to record it from your books, remove it from your books. Exchanging a plant asset, you do not need that. We're not going to get into exchanging because there's that gets a little hairy, so we're not going to do that one. Okay, and then applying generally accepted accounting principles for natural resources and intangible assets. There we would have accounting for natural resources, we have depletion expense. We do not have depreciation. If we're talking about intangible assets, we have amortization. So these are both important to know. Natural resources goes with depletion. Intangible assets go with amortization. Okay. So when we see amortize, we know that's intangible assets. When we see depletion, we know that's a natural resource. And then specific intangibles, you just need to know what intangibles are. We have patents, copyrights, trademarks, franchises, licenses, goodwill. We're not going to get too deep into those. That's just knowing that those exist and they're there for us. So that's what we have. So that's kind of an overview of the 3 chapters on this exam. And those are what I consider the high points. Now, that's not to say you're done.
That should be okay.
You need to practice this in study plans. Study plans is going to give you a lot more practice.
Okay.
But now what I'm going to do is, Brian, do you have audio capabilities? Are you aware you can do audio? Okay. Well then, I'm going to switch you. Yes, I'm going to switch you over to you. Well, I'm going to control. You tell me when you want to move on. Okay. So now Brian's going to talk about. These are things that he saw during
a bunch of exams.
So why don't you go ahead and talk, Brian, and explain where you came up with these things and why.
I noticed that a lot of people.
Hi, Haley.
When we went back through the questions, we started reading the questions again. They were like, "Oh, that was this stupid mistake. I didn't really even think about, whatever the problem was that way." So I kind of came up with, people are reading questions too quick maybe. They're not reading thoroughly enough. Sometimes there will be questions that have a bunch of numbers just, tossed into the problem, but you guys will pick out the wrong ones, the ones that aren't relevant maybe. And just add them all together and get a wrong answer. So you got to go through and pull some relevant information. Also, some people are answering the wrong question. You might read it too quickly and find that the answer to a different question might be on there, the question you thought that was being asked, but it's not. You're not reading or answering the right question. So again, read questions thoroughly and take your time. You've got plenty of it. I noticed a lot of people say that they finished with like 30 minutes left, and if they would have spent that couple seconds extra in just reading the questions a little bit more thoroughly, they would have done a lot better. So that's a good suggestion.
Okay.
Next slide, please.
Okay. Can I hop in here for a second when we're talking about time? On this exam, that I just want to say about the time. This exam, because the problems are a little bit longer than the first exam, you would normally, I would see people taking a little bit longer on this exam, but again, where the first exam, maybe the average time on it was 45 minutes, this exam, I would say the average time is probably an hour. So you have 2 hours. So when Brian says you have time, you have plenty of time, do keep it, keep an eye on the time. It's going to be a little bit longer in terms of how long it takes you. I believe it's the same number of questions. It's just this material takes a little more time than the past. Okay, back to you, Brian.
Okay, next slide.
Okay.
Okay, so use study plan. That's definitely a really good idea. I know a lot of people who were using study plan were getting higher grades. Again, she showed you the statistics from last exam. So use study plan. That's a really good idea. The questions on study plan are very similar to test questions. So if you use study plan, you're going to be more prepared for the test questions. Also, you'll have more experience using the My Accounting Lab software. I know a lot of the little problems that you have to input stuff in. Some people just missed putting in a couple of the fields. And if you do more, Accounting Lab, My Accounting Lab stuff, it'll all come to you, and you'll really understand how to use the software. Dr. Tietz, do you have anything on that, or next slide?
I cannot emphasize enough. I mean, study plan shouldn't be the only thing you do. You should certainly be going through the review guide, making sure you understand the concepts, but study plan is the biggest single thing you can do. I can't tell you how many times people come and we look at their exam and they'll get things wrong on their exam that were exactly in study plan. So study plan there is your practice exam tool. So yeah, I'm done then.
Cool. Next slide then.
Next slide.
Yep. Okay, so using cash as a guide to other accounts. So cash is an easy account to conceptualize, at least I think it is. This is what I do even now in my master's classes. I think about how cash is related to other accounts. So everyone knows that cash increases with a debit and decreases with a credit. So you can take that and use cash to compare it to other accounts. Say you collected sales revenue. That increases cash, so that transaction increases cash with a debit and it increases sales revenue with a credit. Therefore, you know that sales revenue has a credit balance. So it's just an easier way to kind of learn the normal balance of accounts, and then once you conceptualize cash, it's a lot easier to conceptualize all the other accounts and what their normal balances are, so that you can easily think of, okay, why am I debiting this? Because it's increasing. It just makes it a lot easier to conceptualize, I think, when you start with cash and work your way outward. Dr. Tietz, anything?
No, I think it's great advice. Yes.
Okay, good. Next slide. Okay, so eliminate answers that are obviously wrong. So, like she said, and she goes over this in class a lot too, when we're going through questions, she says, let's look at, what the problem actually is, go through the transactions and cut out ones that don't make sense. That's very good advice, and I just wanted to kind of re-emphasize that. If you can knock two 2 answers off, you give it a 50-50 shot on a multiple choice question with 4 answers. So you might also, once you're actually doing that, you might have a revelation or something might kick up in your brain that, oh, this is in fact the right answer. So you cut out 2 of them and then you got 2 left. You'll find that a lot of the times one answer is going to be a lot better than the other. So I think that's definitely a good idea. Anything, Dr. Tietz?
No.
All right, next slide. Okay, so learn things conceptually. Just like cash, that's definitely a good thing to learn conceptually. This opens a lot of doors to further understanding of all the other accounts. And although exams aren't cumulative, the concepts build upon each other, and that is going to help you on all the exams. If you learn things at the conceptual level and understand why they're happening, that's going to help you on every exam. And that's not advice just for this class. This is advice for any class you're going to take for whatever major you are. Learn stuff because concepts build upon each other. I mean, especially accounting, that's kind of crazy. But also, if you're an accounting major, these concepts are going to be important throughout your entire college career or college life, whatever you like to say. So it's best to learn them early and get them in your head. So I think those are all really my advices or my suggestions for you. I don't think advices is a word. So good luck, everyone. Sorry, that was my phone.
So it wasn't,
bye.
yeah. Okay. Okay, so what we've got now, thank you, Brian. What we've got now is we have a little bit of time left if anyone has any questions. Okay. Okay. Anybody have any questions? We'll hang around for a minute or two before. I think Brian, we can stop recording, but we'll just hang out in case there's questions.